Welcome to our special live edition of Ask the Joes and Cale. I'm Joe Lowry Jr. and this is Joe Lowry Sr. and Cale Flagey. And we thought it would be helpful to have a quick chat about some of the things happening in the news, given recent volatility and current events. So we've received a couple of questions, and we're going to handle those kind of extemporaneously as we talk. And just before this started, received a question from a client, and I'll just read that. Hello, just concerned about the market. Do you suggest I should sell most of my stocks, or is it too late? Do you have any suggestions for me? What do you guys think?
Well, Warren Buffett said, "Don't hold cash during the war." And since he bought his first stock in 1942, he's probably kind of an authority on that subject. His thought process there is, during times of war, there's usually high inflation, which is what we're seeing now. And so you're better off, putting your money to work in productive assets, even though they might be losing value currently as stocks sell off. At some point, they are still contributing to society and should recover in the future. Where if you're just holding cash, then that the purchasing power of that is being permanently eroded away. Also, if you're trying to sell, you're trying to basically time the market, and that's pretty difficult because you have to time it twice. You have to sell before things get too bad, and then you have to recognize where the bottom is and then buy back in order to participate in the recovery. And so even if you can get lucky and get the sell timing right, getting the buy timing can be very difficult. We kind of casually follow some timing models that some very, very smart people use and come up with, and they're right sometimes, but a lot of times they're wrong. And we've seen that over the long term, they tend to not actually outpace a buy and hold strategy. It could be a good time to reorient your portfolio. If you have some stocks that you've been wanting to sell, you can sell them now and use tax loss against your income. Or if it's something that you've been wanting to sell, you can sell them, not have to pay as much capital gains, and you can kind of reorient your portfolio into being more sector neutral. I know a lot of people kind of got caught up, during the pandemic with some of the big pandemic winners, with some of the high growth tech stocks. Some of those just got valued to the point of absurdity, and they're not necessarily going to come back to the levels, that they were. But if you look at this year, so far this year to date, from the beginning of the year, energy's up 40%, where tech is down 16% or so. And then you have a lot of the other sectors that are kind of somewhere in the middle, either slightly down. I think financials are down, like 4 or 5%, which of course is significantly less bad than tech being down, almost 20%. And then again, energy, which has done really bad in the past, is up 40% so far this year. So if you can kind of reorient your portfolio into having a more sector neutral approach, it kind of mutes the dramatic swings versus being invested, solely in one sector, which again, a lot of people ended up doing, last year because all the tech stocks were doing so well.
I think you made a really excellent point, Cale. It really reinforces the importance of diversification as a tool for limiting risk during market volatility. It was, I don't want to say easy, but maybe easy to pick some high-flying stocks and really benefit from those as the market was in its post-pandemic or post-recession recovery. But I think you made all the critical points about why that might not be the best approach today. Anything to add on that question, Joe Sr.?
No, I think it's a great time to look for values, and it's a great time to shop right now.
So this brings to a related question that I received also shortly before our meeting. I think a question that probably a lot of people are happening really relates to whether or not we're heading into a recession. This client said, in the midst of significant inflation, Fed tightening, fuel costs, constrained food supply and prices going higher, instability in the Ukraine and elsewhere, what might be diplomatically described as a less productive Congress and government right now. Is it appropriate to become more defensive? Cale, you addressed some of this, but any thoughts? Basically, the question is, are we going into recession? And what are your thoughts on that?
I mean, unemployment has recovered pretty significantly, and there still seems to be, a ton of demand out there. That's also part of the reason why, inflation is so high, is because of so much excess demand. So that doesn't really indicate, I mean, yes, eventually there will be a recession. I mean, over a long enough time horizon, but I don't think one is coming around the corner quickly. We could be energy independent if we needed to be. Europe does not have that luxury, and they're really having an issue with gas prices right now, meaning natural gas for heating and energy production. So I could see Europe going into a recession soon, but I think we're economically insulated enough that I don't think we have to worry about it nearly as much as they do over there.
Any thoughts from you, Senior, about the recession question?
Oh, I think if as Cale, I just reiterate what Cale said, ultimately they do come. But when you look at, I think the figures we saw Monday were there are over 10 million job openings right now. There are only 6+ million individuals to fill those jobs. So there is significant demand in the economy. We're still recovering from COVID. We still have supply chain issues that are being resolved. People keep spending. I mean, you look at the hospitality industry. I was looking at hotel rates for a couple of trips that we're taking later in the year. There has been some relaxation of pricing on that side, which would indicate that the demand, or at least the competition for rooms, is not as high this year as it was this time last year, for example, when we were traveling. So, but the pricing is still high. So that's an indication that at least that sector feels that people are still willing to spend the money. And, the amusement parks and other venues are still, raising their prices, and people are still paying it. Again, I think near term, I wouldn't be concerned about it. And just, if I could interject one other thing, sometimes we have quite a few clients that are invested in mutual funds. In fact, I think a lot of our portfolios use funds. And sometimes, when we talk about buying low and this type of thing, people will say, well, gee, how can we do that in a mutual fund? Well, the fact is that, as we indicate on many times, the reason that funds maintain cash is to take advantage of opportunities on an ongoing basis. And so we would suppose that the fund managers are doing that now, as they have on an ongoing basis in the past, but going through this cycle, even picking up more significant values. So looking forward. So.
Yeah, I agree with you there. There is this significant demand and this undersupply for many things. I was meeting with clients in Orlando the other day, and I think everyone I talked to was either resurfacing a pool, trying to build a pool, trying to make some addition to their home, and a lot of this is being fueled by savings that they've accumulated, and also partly by equity that's been built up in their homes. And so you have not just now this appetite for new homes or people shifting, but that's just one example of an area where the demand remains really strong, and there will be this months-long backlog as the people supplying those goods and services are working their way through. It's not in, at least, and granted, these folks I'm talking to are generally better off than most, but they're not going to cancel their plan just because it's not going to start for 6 months. It's going to happen. I think one thing go ahead.
I think, in real estate prices in bigger markets are still popping. We, have a client who passed away last year, and the family, is waiting for, the property to be probated. But initially the valuation was about $550, somewhere in the neighborhood. And one of the children just emailed me a listing in the neighborhood, like 2 houses down, for a home that is on the market at 745. So you know, some areas may be priced to the max, but now what's happening is other areas maybe that were in the lower range are beginning to pop because, you know, people can't get in that higher price anymore. Now they're looking, you know, at a more median range property. So there's still high demand, and interest rates are still low. So we would expect, you know, that sector to continue pretty healthy for the time being. So,
you know, I think if I was to summarize, I'd say that our answer to that question is that a recession is not imminent, that the things that would have to happen to cause our economy to shrink, and not just to shrink, but to shrink for 2 consecutive quarters, the traditional definition of recession, that those circumstances are not present and are unlikely to be caused by what's happening in the world at large. And I wanted to hit on something, adding something that Cale mentioned before, which really has to do with the peril of timing. I like what you said, Cale, about the need to be right, you know, twice when it comes to trying to time things. And I think that's why we spend a lot of time with clients talking about timeframes and your specific needs and goals. And so a portfolio should be designed in such a way that it reduces or removes some of the timing question from our kind of from our mind. In other words, if I know that my need for this money, for example, speaking about the first question we had, imagining that comes from a younger client, which in fact it does, given their time frame in particular, it doesn't make sense for them to be very defensive because they could easily be in the wrong place when it happens. Now, for a client who's retired or close to retirement, their portfolio will already be invested in a way that it should be appropriate for good markets, and if they happen, for bad markets. At least that's always our objective. So for the most part, in nearly every circumstance, our answer is going to be, you know, hang in there. Don't make changes based on what's happening in the broader economy or the world, or what seems to be happening. Because really most of the time the focus needs to be on your specific personal economy, what it is about your situation. And if your situation is changing in response to what's happening in the world, well, then that might necessitate an adjustment to your portfolio. But if your situation is largely continuing as it has been, then it probably makes sense to hold the line. And adding to what you said, Joe Senior, about, and don't worry, I see your hand raised. I'll get to you in a moment. But adding to what you said about the kind of activity that happens in accounts over time, most of our clients, if they haven't, will shortly be seeing some rebalancing activities in their accounts, where we're making adjustments so that the portfolios fit the targets that we have had in place for them. And that rebalancing activity is a way of following that principle of buying low and selling high. Some areas of the portfolio will have declined in value in response to what's been going on in the world. Others will have held value a little bit better, and by rebalancing, we take advantage of those movements and position you a little better. All right, Joe Senior, you're up.
Well, you know, this is purely anecdotal, but I've been in the financial services business for 48 years, and I have never ever seen anyone who excelled over time by timing the market. If I had, you know, we would be advocating it, but it just hasn't. Yeah, we just haven't seen the evidence is not there. Secondly, the other common response is, or a question we get from people that's concurrent with, you know, should I sell what I have right now or whatever, is people who participate in 401k plans or other qualified plans may have a tendency to pull back and not invest right now, you know, because they're concerned about, you know, about what may happen. And again, the beauty of systematic investment or dollar cost averaging into portfolios, whether they're retirement accounts or personal accounts, the evidence there is overwhelming that over time that is proven to be a very good strategy. and of course, always balanced out and in accordance and in harmony with one's risk tolerance. So.
Great, thank you.
Yeah.
Anything to add on that question, Cale? All right, let's move on to another question. How will the ban on Russian oil and gas affect us here in the United States? Cale, you want to start with that?
Well, temporarily, things will definitely get more expensive when you're removing that much supply from the global market. Oil gets moved around elsewhere, but you still have to make up that production loss somehow. So that puts a squeeze, pretty much on everybody everywhere. But over time, it'll get sorted out as places increase, production. So.
Senior, any thoughts from you on that?
It's not a long-term concern for me. So.
Yeah, I saw something that was helpful, some commentary given by JP Morgan. I'm not sure exactly what his title is, but David Kelly works for JP Morgan. And he said that, the impact on the US economy will most likely be felt in the higher gas prices for families. If, for example, recently, the price for West Texas Intermediate crude had spiked to $123 a barrel. This was prior to the banning of Russian crude. If they stayed at 123 a barrel for the rest of the year, gas would likely average close to $4.20 for the rest of the year, which would result in an additional $1,000 to the expenses of the average household. So it is something, would affect other areas of consumption maybe, but that by itself is not enough to cause the economy to shrink. There are other collateral effects, transportation costs and those kinds of things. But
well, it's reflected. For example, your mother went to the grocery store and came back and said, "Look, this is priced higher, particularly in the produce area." And of course, produce is transported by trucks, and trucks have to pay for the fuel. So a lot of the consumer products that we buy, we'll see those prices elevate just like gas has, not in the same proportion, but the prices will go up as a reflection of what transporters, that transportation cost has to be factored into it. So,
and in the short term, it will boost those inflation numbers a little bit probably as well. Great. What about inflation generally? Cale, you mentioned something in your initial answer to the first question about stocks being a good place during inflationary periods. Do you want to expand on that at all?
Yeah, I mean, they can definitely react to the negative sentiment of inflation by going down. So I wouldn't say it's necessarily a short-term inflation hedge, but over the long run, if you're a consumer packaged goods company, for example, your input costs are going up, so your profitability is going down, which can cause your stock to sell off. But over time, you're going to be able to raise prices gradually on your product to the end consumer, and you'll eventually, make up that profitability over time. So again, as long as you're buying, companies that are productive and, still contributing, to society, to the economy, then in the long run, again, you're going to be better off than just holding cash, which is just going to have, a losing effect to its purchasing power.
Yeah, I'd refer everybody to, I'm going to share my screen for a minute. As you know, because we share it quite a bit, Commonwealth has a great blog, the Independent Market Observer, where they provide different commentary. And we like to quote from this in the Lowry letter. There was a post from February 25th about whether could some sectors benefit from inflation. And if this is a question that interests you, that'd be a great thing to look at. But in particular, are equities a hedge against inflation? When inflation is low and rising, as is generally the case during the start of an economic cycle, it's good for stocks, good for equities. And you can see here in most periods when inflation, really regardless of inflation, whether it's low and rising, high and rising, low and falling, high and falling, US equity returns have generally exceeded the inflation rate. So it's a good time to mention that past performance is no guarantee of future results, but we do feel confident that when we consider the alternatives when it comes to fighting inflation, cash remains extremely unattractive. Fixed income is appropriate for part of many investors' portfolios, but is not the part that we hold for its inflation beating. We hold it for the other characteristics that fixed income can provide. And we think that having exposure to stocks is vitally important. And like Cale said, not every sector in the stock market is going to do well when inflation is high, but a diversified portfolio should benefit overall from that exposure.
Well, this is why we advocate, even in retirement portfolios, equity participation, because that becomes comprises the growth potential or the growth element that will enable, or that historically has enabled people to keep pace with inflation in terms of the income that they're drawing off of their portfolios. You know, I recall very vividly in 1980, thereabouts, or coming into the early 80s, when inflation escalated up to as high as, I think, 17%. And at that point, banks were offering CDs in the 16-17% range. Bonds were yielding higher, and there was a tremendous migration of a number of retirees into those interest-bearing instruments. What happened, though, is ultimately things leveled out. Inflation came down, and people had become accustomed to living at that 16-17% interest rate, and all of a sudden yields were cut by half, and now they couldn't live that lifestyle anymore. In fact, they were spending into their capital. So the argument for equities, as the graph pointed out, historically across all investment spectrums, it continues to be very, very powerful. So
I'll just point out, if anyone has any questions, this is a great time to submit them. We're just about at the end of the questions we've received. So if there's anything else you'd like to ask us about, now is the time. I think we're planning to do this again next month. We'll provide a little more notice. We just wanted to make sure that we could do something in the short term, given everything going on. Just prior to this call, we listened to a little bit of commentary from a former official with the Central Intelligence Agency. And he did share some sobering things about the conflict, the war in Ukraine, particularly that it is likely that conditions there will continue to worsen for the Ukrainian people, and some kind of long-term siege scenario for the capital city, Kiev, is likely. So it's going to continue to be a part of the news. It's been, I think, very heartening for all of us to see the response of the Ukrainian people and the solidarity of many people around the world and governments against something that we'd all agree is a pretty awful undertaking by the Russian government and by Putin. But we're hopeful that, anyway, hoping for a good outcome there. The economic impact, like we mentioned a couple of weeks ago in the Lowry letter, of both the Russian and the Ukrainian economies is relatively small. This is just one piece of that puzzle, but a question that comes up sometimes is, what exposure, here's a question we've had, what exposure do I have to Russia's market? Cale, I think you did some research on that the other day. I don't know if you remember the numbers offhand.
Yeah, we use a few emerging markets funds, but the one that we use which Russia is considered an emerging market. One of the ones that we predominantly used, the exposure to Russia directly was less than 0.2%. Some emerging markets funds get as high as 10% exposure to Russia. So we're really thankful that we don't own those, fortunately. But obviously, you probably heard in the news that many companies like McDonald's, Starbucks, KFC, oil and gas companies, etc., do have a segment of their revenue that comes from Russia, and a lot of them have pulled out, so their revenue will be hurt a little bit. But again, for most companies, not in a very large amount.
Yeah, I think there was one fund in some portfolios that emerging market fund, which was 3 or 4% of the portfolio itself, had, I think, 3% exposure to Russia, mostly in the energy area. At least it may not have at the time, but it was as of I think the end of the year. And so looking at that on the whole, it's a pretty small percentage overall. All right, we do have a question here. In your opinion, is it too late to add exposure to energy? Has the energy market or energy stocks, has that run its course? Let's all pull out the crystal ball. And what do you think?
I think you should always have a little bit of exposure to energy because of sector diversification reasons. I would not have it be more than 2 to 3% of your portfolio, just because it is cyclical and it goes through very long periods of very long and steep drawdowns. If you have mutual funds, you might have some decent energy exposure already in those funds. So I would check there first. But yeah, I mean, if you had zero energy exposure, I would consider adding a little bit at this point. But again, I would not overweight it because, again, it's already up for 40% year to date. And we don't know exactly how long that can hold. That being said, a lot of the domestic energy companies have been hurt so bad in the past decade that rather than rushing to increase production to take advantage of the high prices, a lot of them are kind of sitting back and taking the profits right now to kind of shore up their finances, just because they have a little PTSD from the long energy drawdown that happened here in years past.
Yeah, I was reading that some of those Canadian tar sands, a lot of the big companies had pulled out of there altogether. And so some smaller companies had come in, but there is some room there for production increases domestically and in Canada and other places that will help to meet some of this supply issue, but it will take time for that to ramp up. Senior, any thoughts on the energy question?
No, me personally, I would not increase my exposure to energy right now. So,
as Cale said, most people have some exposure already through
Right.
the assets they own.
Right. But I personally would not add to that. So.
All right, any other questions before we say goodbye today? If not, feel free to send them to us. You can email any one of us directly, and we'll try to answer them in the Lowry letter and or at our next webinar, date to be determined, but sometime in April. And we'll see if any of our educated guesses were on the mark. And as always, we encourage you to be focused on your specific goals, needs, and situation. Our discussion today was not meant to it was meant to be educational and not represent a solicitation to buy, sell, or hold any particular security. And any specific choices about your investment portfolio should be made in concert with your friendly financial advisors, such as the Joes and Cale. So thanks for joining us. Thanks for your questions. And we'll see you next time.
Thanks, everyone.